Microchrome Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monaco.
G'day and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Well, let's check what happened overnight. Value stocks, which have underperformed their growth peers, ended sharply higher on Wall Street, while European stocks lost some ground. US retail sales data supported the notion that the economy remains resilient, while inflation cools, which buoyed stocks. The Dow had its best session in almost a year to reach an all-time high, while the rotation into small caps continued, which saw the Russell 2000 achieve its fifth straight gain of more than 1%, taking it to a 2.5-year high. Weaker mega cap growth stocks such as Nvidia and Microsoft capped gains on the Nasdaq. Bank of America's second quarter profit beat expectations and underwriting fees rose as capital markets resurged. The second largest US bank also provided upbeat net interest income guidance, sending its shares higher. Morgan Stanley rose even after the investment bank posted disappointing wealth management revenue. And Charles Schwab slid after reporting a dip in interest income. Elsewhere, United Health Group shares jumped after reporting consensus topping profits. Well, US retail sales were unchanged last month while the underlying trend was strong. Core sales up 0.9%. And the Atlanta Fed's growth projection for the US economy for the second quarter has been increased to 2.45% from 2% following the retail sales data, while real personal consumption expenditure was increased to 2.1% from 1.6%. And Fed Governor Adriana Kugler has said if economic conditions continue to evolve in this favourable manner, with more rapid disinflation, as evidenced in the inflation data of the past 3 months, and employment softening but remaining resilient as seen in the past few jobs reports, I anticipate that it will be appropriate to begin easing monetary policy later this year. Well, the yield on the US 10-year Treasury note has fallen to a 4-month low on expectations that the Fed is getting close to cutting interest rates. It's down to 4.16%, the 2-year is at 4.44%. And the US dollar has risen on signs of US economic resilience. The Aussie weakening to 67.3 US cents. Well, earlier I caught up with Tim Richardson from Pengana Capital, who spoke about those geopolitical risks and the impact they're having on global equity markets.
You say a lot's happened recently. Even before Saturday's events, it looked more likely that Mr. Trump would be re-elected after the shortcomings of President Biden became apparent in the debate and in the press conference following the NATO leaders summit. And of course, the events of Saturday have reinforced the view of pundits and polls and bookmakers that we're likely to see a return of the Trump administration. But what we've got to be a little bit careful about is trying too hard to connect a shift in the political environment to a change in the macroeconomic policy, to a change in investors' expectations of GDP and company earnings growth, and that's what actually drives share prices. So the commentary can get a little bit carried away, but it's a very imprecise connection between these events. But what we're likely to see if there is a Trump victory in November is you're likely to see a few things. We're likely to see tax cuts that are not matched by cuts in spending. We're likely to see more controls on immigration. We're likely to see higher tariffs, particularly on Chinese goods. And you may even see a new Fed chair that's a bit more dovish. All of these things together are likely to be a bit inflationary.
Yeah, to that point, as you say, inflationary, that's sort of be priced into markets at the moment with the likelihood of a Trump win, and therefore you have seen those longer dated Treasuries, the yield move higher as
That's
a
right.
result when you mention lower taxes, the likelihood of tariffs, plus a light touch on regulation as well, which is only going to increase US debt.
That's right. Inflation's likely to lead to higher interest rates in time, which may give some support to the dollar, but you're likely to see more bond issuance. That's likely to push up bond yields over time, which other things being equal can be negative for share prices. However, what we're likely to see offset that, particularly in the short term of any new Trump administration, is the sugar hit from tax cuts, which are likely to be rolled over, which is likely to support share prices in the near term. And I think that's what some investors are getting a bit excited about.
Yeah, so how are you seeing that play out in equity markets at the moment? Because as you say, it sort of appears, a Trump presidency would broadly be positive for stocks. But at the moment, we're also seeing the prospect of interest rate cuts, that rotation into small caps and into value stocks. Is that sustainable? Do you think that rotation is here to stay?
Yeah, there's always a time lag between the behaviour of larger caps and the smaller caps, and perhaps we've seen that time lag extend a bit in this particular cycle. Larger caps anticipate the fall in interest rates quite a way in advance. That's why you've seen this strong recovery, particularly in growth stocks over the last 12 months or so. And that's opened up a really steep discount between the valuation levels of large caps and small caps, such that small caps are particularly attractively valued. Now what we've seen over the last few days is, now that the market is more confident that we'll see, perhaps from September, lower US rates, that big rotation into the smaller caps. That's because those companies tend to be more sensitive to borrowing costs, particularly with regard to whether or not there's going to be a soft landing or not. And the data that seems to be coming out seems to indicate that we will see a soft landing. You saw the retail sales numbers in the States come out last night. There's no sign of a recession in the near term. That's a good environment for small caps, particularly when they're so attractively valued.
How are investors factoring in geopolitical risk at the moment? Obviously, with what's going on politically in the US, plus we've had elections in France and the UK, and you look more broadly at conflict across the globe. How does that play into positioning?
I think investors tend to take a country or regional specific view of these things. You mentioned the French election. The second round that we saw recently has ended up with a hung parliament, and it's very unlikely that a government is likely to emerge there that's able to take difficult decisions. You've seen the bond yields in France blow out a long way above the German benchmark, and that's the market acknowledging the fact that there's very little appetite within the French political establishment to bring borrowing down to a level that fits the EU rules. Furthermore, it's unlikely we'll see a government in France that will implement those structural reforms that the country with a ageing population desperately needs, such as Macron's plan to shift the retirement age from 62 to 64. There's some great companies, particularly export-orientated companies in France. You think of Vermeer, Schneider Electric, but the domestic economy's got some real problems. UK, on the other hand, has been in a world of pain for the last few years, but perhaps surprisingly, that's now in a situation where it's likely to see more political stability over the next 4 or 5 years than the other leading developed economies. It's got a centrist government, big parliamentary majority, committed to closer ties with Europe, and doing something with deregulating the planning system, which is going to be positive.
There's something of a shift going on in Europe, because just in the past couple of days, in fact, we've seen some profit warnings essentially from those luxury goods companies, the likes of Swatch and Burberry. What are we seeing at the higher end? Because we've seen that bifurcation here, haven't we?
Yeah. Between
the wealthy and those that are perhaps struggling, and the wealthy have managed to keep spending.
That's right. When we talk about the luxury sector, it's probably as well to not treat it as an amorphous mass. The bulk of the of the luxury sector has found out, particularly recently, that it's a little bit more sensitive to any downturn in consumer spending. And remember, in Europe and China, the consumer's under a lot of pressure. And those companies are seeing a bit more sensitivity to that downturn than they expected. Whereas if you look at the really top end of luxury, think of Vermeer, the French-based group, and also Ferrari. Okay, it's a car company, but it's very much in that same segment. They're doing fine because the top end of the luxury market isn't impacted by things like mortgage rates, and it's got capital to spend.
Tim, you mentioned there earlier the Trump presidency essentially likely to see those tariffs ramp up, particularly on China, Chinese goods. What did you make of that latest data dump we got out of China, certainly underscoring that weakness still in the economy?
Yeah, that's right. We saw the GDP numbers on Monday. In the 12 months to end of June, the economy expanded by 4.7%. You think that's pretty good from where we sit, but that was down from 5.3% in quarter one. The economy is clearly slowing. What's driving that is the weak retail sales and inflation. Price levels are now flirting with deflation. That's all driven by the very weak housing market and also the high youth unemployment, made worse by the fact there's little in the way of a safety net there. So what this means is that whereas the exports of the industries that are favoured by the Chinese government, EVs, clean energy, AI, they appear to be doing well. The domestic economy is in a bit of a mess. That's a problem at the moment because we're just at the point where we're facing a change of government potentially in the US that's absolutely committed to increasing tariffs and reducing the trade imbalance between the US and China. So that's a big problem for that economy over the medium term. There's some good companies in China, good quality, well-run businesses, but investors have got to be a bit careful now.
Tim Richardson from Pengana. Righto, let's take a look at where we're likely to get going. As you can see, SPI futures up 0.7%. So looking for a strong start at the open, which is just a couple of minutes away.